Welcome back to Iron Financial. Listen, our mission here is simple and it is absolutely unyielding. We are here to help you forge a stronger portfolio and cut through market weakness with absolute precision. Today, we are bringing out the heavy machinery for a deep dive explainer on one of the most explosive, heavily debated names in the market right now. We're talking about DraftKings. We are breaking down their latest multi-billion-dollar earnings report, but more importantly, we are inspecting the blueprints of their incredibly aggressive, high-stakes pivot into the prediction markets. This is a sector that is suddenly threatening to disrupt the entire traditional sports betting landscape, literally overnight. And as always, I am right here to represent your portfolio's defense system. We really need to figure out if this company is experiencing durable, structural growth, or if retail investors are about to get completely crushed under a collapsing ceiling of Wall Street hype. We have all seen these massive pivots before, right? We need to know exactly what is driving this one before we pour any concrete.
Because the big structural question we absolutely have to answer today is exactly this. Is DraftKings actually building a solid foundation, or is this entire massive operation just a house of cards waiting for a stiff breeze? I mean, they are throwing around massive top-line revenue numbers, sure, but we've seen these growth-at-all-costs traps before. Usually, when a company suddenly pivots heavy resources into a shiny new sector like prediction markets, it's a massive red flag. It often signals that customer acquisition costs in the core business are just spiraling out of control, and the foundational model is starting to show some critical cracks.
Well, that's exactly the stress test we are running in this explainer today. We are going to drill deep into the raw financials, totally ignore the PR noise, and inspect the actual structural integrity of their balance sheet. Let's look at the bedrock.
The core foundation of DraftKings rests squarely on its massive sports betting and iGaming brand. And the raw data from fiscal year 2025 suggests they have built an absolute fortress. We are looking at full-year revenue exceeding $6 billion, representing a massive 27% year-over-year growth rate. But here is the critical structural shift that every serious investor must acknowledge right now. For the first time in the company's entire history, DraftKings finally flipped to a positive GAAP net income of $3.7 million. Hold on, let's keep our hard hats on here for a second. $3.7 million in net income on over $6 billion in revenue isn't exactly a massive vault of profit. Come on. That is a razor-thin margin for a company of this sheer size. You're completely missing the broader context here. It's a massive turning point because it proves their model is actually viable. It proves that the multi-year, multi-billion-dollar cash burn phase they used to acquire customers is finally yielding sustainable returns, rather than just empty top-line hype. They improved their net income by over $511 million compared to 2024's massive loss. Plus, their sportsbook handle increased 11% to a staggering $54 billion. The heavy lifting of their initial expansion phase is effectively over, and now we are seeing the infrastructure generate real, actual capital.
Let's drill even deeper into the most recent Q1 2026 balance sheet to really prove this point. Revenue jumped 17% year-over-year to $1.646 billion, cleanly beating Wall Street estimates. And again, look at the net income line for the quarter. They went from a $33.8 million loss in Q1 2025 to a $21 million net income gain. The profitability is clearly inflecting upwards, and it's doing it fast. Okay. But I'm looking at the exact same ledger, and I'm looking right at the cost of revenue. It climbed from $843 million to nearly $949 million. The raw materials required to keep this engine running are getting significantly more expensive. Sales and marketing are still burning over $400 million in a single quarter. If they are truly scaling efficiently like you say, why are the operating costs still requiring so much heavy lifting?
Because they are actively pouring concrete into high-return opportunities. The key metric you're missing here is the margin improvement. The sportsbook net revenue margin increased to 7.8%, up from 6.4%. This is driven by what the industry calls a higher structural hold percentage. That essentially means DraftKings is mathematically keeping a larger chunk of the total money wagered because bettors are making more complex, lower probability bets. They are keeping more of every dollar that flows through the system.
If you want undeniable proof of their structural integrity, look at the cash flow generation power they unlocked at the close of last year. In Q4 2025, Adjusted EBITDA experienced a staggering four-fold increase, literally rocketing from $89 million straight up to $343 million.
Market skeptic? Wait, 4 times the EBITDA in a single year? Okay, I'll admit, that is a massive load-bearing pillar. But how exactly are they engineering that kind of jump?
Exactly. They forged a 17% margin, which is up over 1,000 basis points year over year. That is exactly what happens when you finally establish brutal economies of scale. The promotional reinvestment gets vastly more efficient, and the highly lucrative parlay handle mix rises by nearly 500 basis points. For those newer to the space, a parlay is a multi-leg bet that requires several outcomes to hit. They are notoriously hard to win, essentially acting as a massive, high-margin cash generator for the house compared to standard straight bets. This isn't theoretical hype we're talking about. This is cold, hard operational execution at scale.
All right, but let's take a sledgehammer to this so-called dominant position for a minute. You want to talk about cold, hard numbers? Let's look at the actual user base. 4.2 million. That is the number of monthly unique payers, or MUPs, in Q1 2026. And guess what? That actually represents a 4% year-over-year decline. Wall Street absolutely murders tech and gaming stocks that show decelerating user bases.
I completely anticipated you would inspect that specific crack in the foundation.
Oh, it's my job. You absolutely cannot build a $6 billion revenue skyscraper if the foundational user base is literally leaking out the back door. Are there serious cracks in the armor here? If DraftKings is the undisputed king of the sector, why are people leaving the platform? Is the core traditional sports betting market totally saturated at this point?
You need to inspect the structural context, not just the raw decline. That 4% drop is almost entirely due to a very deliberate operational shift, DraftKings exiting the lottery business in Texas. If you exclude that structural exit, MUPs were actually up 2%. But more importantly, notice the $131 yield metric. That is the average revenue per monthly unique payer. Market Skeptic.
So you're telling me they're just squeezing their remaining users harder?
I'm telling you they are monetizing them 21% more effectively. They are extracting $23 more per user than they were exactly a year ago. How? Cross-selling. They are taking a traditional NFL bettor and successfully transitioning them into a high-margin iCasino, blackjack, or slots player during the off-season. Their revenue retention per user remains above 100% after the initial cohort churn period. They simply don't need a massive, expensive influx of new users if they are consistently forging stronger, vastly more profitable relationships with their core demographic.
Okay, that makes mathematical sense, but institutional money is actively flashing warning signs about the product itself. I mean, look at this direct quote from the Janus Henderson Investors 40 Fund. They specifically noted that traditional sports betting may be losing ground to the growing popularity of the sports prediction markets. This isn't just retail trader panic here. This is smart money getting very nervous. In traditional betting, you place a static point spread bet before the game and just wait. In dynamic prediction markets, users trade real-world outcomes in real time, entering and exiting positions based on shifting probabilities. If users want that fluid trading experience, DraftKings' static core foundation could become dangerously obsolete and fast.
And that brings us to the ultimate counteroffensive. DraftKings management isn't just waiting around for their foundation to sink. They are actively expanding their blueprint as we speak. They are launching a massive, fully funded expansion into the prediction markets. This is a sector that analyst estimates suggest could be a $10 billion annual gross revenue opportunity.
So they recognize the threat and are desperately trying to pivot before they get disrupted.
They aren't just pivoting, they are positioning themselves to completely monopolize the disruption. They formally launched DraftKings predictions under the strict oversight of the U.S. Commodity Futures Trading Commission, the CFTC. This is a massive regulatory moat. This isn't some unregulated offshore crypto gambling gimmick that could be shut down by the government tomorrow. They are building a highly durable, regulated financial framework to capture a completely new demographic of retail traders safely and legally within the United States. Let's break down the technical architecture of this new growth lane, because this is where the real structural power lies for our Iron Financial listeners. They are integrating cutting-edge Railbird technology. They are launching an in-house market-making division. They are acting as an introducing broker for futures commission merchants and launching a designated contract market.
Okay, translate that barrage of financial engineering into English for the everyday investor. What does that actually build at the end of the day?
I'll put it simply. Instead of just taking bets against the house, DraftKings is literally becoming the stock exchange for sports outcomes. They provide the liquidity, they match the buyers and the sellers, and they collect the tolls. By bringing market making in-house, they capture the actual trading economics. They calculate the sports probabilities, set the market, capture the spread on every single trade, and control the entire economic loop on their proprietary exchange. It turns a bettor into a day trader and turns DraftKings into the exchange itself. But how do they actually get their casual sports bettors to adopt this highly complex trading interface? You can build the most advanced market-making engine in the world, but if the mobile app requires a finance degree to use, the casual fan is just going to go back to a standard moneyline bet somewhere else. Lead Analyst. DraftKings' ultimate structural differentiator is their integrated super app. It is a completely seamless interface. To solve the complexity problem, they're introducing exclusive combination wagers, or combos. These combos bridge the gap by packaging complex prediction contracts into simple yes or no parlays that a casual football fan already understands perfectly. They don't have to learn how to trade futures contracts. They just tap a button. DraftKings already has the massive user base. They're simply offering them a new, highly engaging financial instrument within the exact same fortified ecosystem.
So, let's stress test their future by looking at the official 2026 guidance laid out by CFO Alan Ellingson. They are projecting revenues between $6.5 billion and $6.9 billion. More critically for our bottom line focus here, they are guiding for $700 million to $900 million in Adjusted EBITDA.
That's a fairly wide range, honestly. It shows me they are building in a lot of contingency padding for a rapidly shifting market.
It reflects disciplined, ironclad planning. It assumes state tax rates remain consistent with today, and it actively absorbs the heavy startup costs for new jurisdiction launches like Maine iGaming and Alberta, Canada. What's absolutely crucial here is they are cash flowing these massive territorial expansions organically from their own profits, rather than going to the market and raising massive amounts of new, expensive debt.
Okay, I'm putting my hard hat back on and going straight on the offensive here. Let's look at that revenue guidance again. 6.5 to 6.9 billion. If you do the math, that implies a nearly 11% deceleration in revenue growth compared to their massive 2025 numbers. Wall Street analysts like Daniel Politzer noticed this immediately on the earnings call. I demand to know why a so-called solid foundation is suddenly slowing down its top-line growth so much. Is the core market finally tapped out, or are they bleeding market share to competitors?
That is exactly the trap that retail investors fall into when they refuse to read the actual transcripts. You are looking at the deceleration and blindly assuming structural weakness. Let me drop the ultimate ace of spades on you. Listen to this direct quote from CEO Jason Robbins regarding that exact 2026 guidance. He says, "Predictions really is all upside. There's nothing in terms of revenue in the guide." Market skeptic. Wait a minute. Zero? They modeled absolutely zero revenue from the new platform? Absolute zero. Robbins even told his executive team to lower the internal projections multiple times. Why? Because he is applying a philosophy of under-promising and over-delivering to forge deep institutional trust and build a highly durable valuation. The highly conservative $6.5 to $6.9 billion guidance completely excludes the hundreds of millions of dollars expected from the new predictions launch. The executive team explicitly confirmed that any financial contribution from this $10 billion prediction market is pure, unmodeled upside to their current outlook.
It is time for the final structural inspection. Let's weigh the hard data with a rapid-fire rundown. On the opportunity side, you have a massive $343 million Q4 EBITDA generation.
But on the trap side, you have to acknowledge the heavy operating costs requiring nearly $1 billion a quarter just to run the core revenue engine.
True, but they just achieved positive GAAP net income, proving the model absolutely works, and they are extracting a massive $131 yield per user.
Yet they suffered a 4% raw drop in monthly unique payers, which always makes the market nervous regardless of the Texas exit.
And finally, they have an entirely unmodeled predictions market that could act as a massive, high-margin revenue multiplier,
countered by the undeniable reality that they are pivoting into a highly complex, heavily regulated CFTC environment that could severely cannibalize their core sports betting audience if executed poorly.
Which brings us to the final iron financial verdict. Will DraftKings' new blueprint forge an untouchable market monopoly, or will the heavy lifting of this prediction market expansion ultimately crack their traditional foundation? From the analytical side, the balance sheet shows ironclad strength. The pivot to prediction markets isn't an act of desperation, it's a calculated act of aggression. They are taking their highly monetized user base and funneling them into a pure market-making ecosystem.
From where I sit, the core business isn't a house of cards. It's finally generating real cash. But the market has priced in a lot of perfection here. If the predictions rollout faces severe regulatory headwinds or fails to engage the casual bettor, that 11% deceleration in the core business is going to look like a glaring structural flaw. Investors need to tread very carefully.
If DraftKings pulls this off, they won't just be a sportsbook anymore. They'll be a massive financial exchange in disguise. The question is, are you pricing them like a casino or like the next Wall Street? Do your own heavy lifting, stress test your portfolios, and we will see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.